Here is something your school never put on a test. Your parents probably never said it out loud, and most personal finance advice gets completely wrong. Debt, used correctly, is one of the most powerful wealth-building tools ever invented. And debt, used wrong, is one of the quietest ways to stay poor for decades without ever feeling like anything is going wrong. The problem is not debt itself. The problem is that nobody ever taught you the difference. Not in school, not at home, and not in the advice column that told you to cut up your credit cards and never borrow again. By the end of this video, you are going to understand debt the way wealthy people understand it. Not as something to fear, not as something to blindly embrace, as a tool with a right way and a wrong way to use it. And once you see it, you cannot unsee it. Welcome to Gigi Invests. If you're new here, subscribe. Every week, we break down the money concepts schools skipped, so you can actually build wealth instead of just reading about it. Part 1. Where the fear came from. Let's start at the beginning, because before we talk about debt, we need to talk about what you were taught about debt. Most of us got one of two lessons growing up. The first lesson came from parents or grandparents who lived through hard times. Their message was simple: debt is danger. Owe nothing, own everything. If you can't afford it, you don't deserve it. That lesson came from real pain, from watching people lose homes, lose businesses, lose everything because of money they owed someone else. And for the era they lived in, it was not wrong advice. The second lesson came from school, except school did not really teach personal finance at all. Most students graduate having learned algebra, Shakespeare, and the periodic table, but not one class on how interest compounds, not one lesson on the difference between a mortgage and a credit card, not 1 hour on what happens to your money when it sits in a savings account, paying next to nothing. So you left school with either inherited fear or a complete blank. And then the adult world handed you a credit card application. That is not an accident. The financial system does not profit from your education, it profits from your confusion. When you don't understand how debt works, you make expensive mistakes. You avoid debt that would have made you richer. You carry debt that is quietly draining you, and you never quite know which is which because nobody ever taught you how to tell. That changes today. Stay with me, because in the next section, I'm going to show you the single number that determines whether any debt makes you richer or poorer. It is not the one most people check. Part 2. What debt actually is. Stripped down. Let's strip debt down to its bare mechanics. Because most people carry debt for years without ever understanding the machine they are dealing with. Here is what debt actually is. Someone gives you money today. You agree to give them back that money later, plus a fee. That fee is the interest rate. That is it. A mortgage works that way, a car loan works that way, a credit card balance works that way, a student loan works that way. The instrument is identical. Money now, more money later. The only thing that changes, the only thing that actually matters, is the rate you are paying to borrow. And here's the rule that the rest of this video builds on. Every debt either costs you more than your money could earn elsewhere, or it costs you less. That is the whole game. If you are paying 20% interest on a credit card balance, your money is working against you at 12% per year, every year until it is gone. But flip it around. If you have a fixed mortgage at 3% and you could reasonably expect your investments to return 8 or 9% over time, then paying that mortgage off early is actually the worst financial decision because your money works harder invested than it does eliminating cheap debt. Same instrument, opposite outcomes. The only variable is the number. This is what the wealthy understand that most people do not. Debt is not good or bad. Debt is a rate measured against an alternative. Point it the right way, and it builds wealth. Point it the wrong way, and it drains it. And the direction it points depends entirely on one comparison that most borrowers have never made on even one of their loans. So what is that comparison? Your debt's interest rate against the return you could earn on that same money somewhere else. That is it. That is the whole formula. Let me make it concrete. Say you carry $8,000 on a credit card charging 21% interest. That is $1,680 leaving your account every year, not paying down the balance, just renting the debt. Now, ask yourself, is there any investment available to a normal person that reliably returns 21% per year, guaranteed, tax-free? The stock market has returned around 10% per year over the long run, and that return is not guaranteed, not smooth, and it is taxed. The best high-yield savings accounts right now pay around 4 to 5%. So, no, there is no investment that beats 21%, which means paying off that credit card is mathematically the best investment available to you. Not the stock market, not real estate. The credit card bill sitting in your inbox. Now flip it. Say you have a fixed mortgage at 3% and you have extra cash sitting there. Should you pay down the mortgage early? Only if you cannot earn more than 3% elsewhere. And historically, over long periods, a diversified stock portfolio has earned significantly more than 3%. So paying off a 3% mortgage early when you could be investing is often the wrong move. Not because debt is good, because cheap debt, below what your money can earn, is costing you less than it could be making. This is the line. Below it, debt is cheaper than your alternatives. Keep it. Invest instead. Above it, debt costs more than your alternatives. Kill it. Fast. Here's a practical breakdown for right now, in today's environment. Credit card debt above 15%? Emergency. Attack it immediately. Nothing else comes first. Personal loans or store financing above 10%? High priority. Pay these down aggressively. Car loans around 7 to 9%? Above the line for most people. Pay on schedule, accelerate if you can. Student loans around 5 to 7%? Gray zone. Keep paying on schedule, invest alongside them. Fixed mortgage at 3 to 6%? Likely below the line. Invest the difference rather than prepaying. One detail that makes this sharper. Paying off debt is not just any return. It's a guaranteed tax-free return. When you earn 10% investing, the government takes a cut. When you eliminate a 20% debt, you keep the full 20% because you are removing an expense, not earning income. That's why high-interest debt is even worse than it looks on paper, and why killing it is even better than it looks. Coming up, I want to show you how two people, same income, same salary, end up in completely different financial positions 30 years later. The only difference between them is which side of this line they were standing on.
Part 4. Two people, one line, 30 years. Let me show you what this looks like in real life. Meet Sarah. Sarah is responsible by every measure most people use. She pays her bills on time, she does not spend recklessly, she considers herself careful with money. Sarah also carries $9,000 on a credit card, the kind of balance that builds up slowly over years and never quite feels like a crisis. She pays a few $100s a month toward it. The balance drifts down, life continues. Here is what Sarah has never calculated. Her card charges 22% interest. On $9,000, that is nearly $2,000 a year in interest, before she pays down a single dollar of what she owes. At her current payment rate, it will take her 5.5 years to clear that balance, and along the way, she will hand the bank over $5,500 in interest on a $9,000 debt. She will pay nearly $15,000 to retire a $9,000 balance. Sarah is not irresponsible. Sarah was never taught what she was actually carrying. Now meet Marcus. Marcus has a mortgage, a 30-year fixed at 5.5%. By the old framework, that is good debt. He is fine. But Marcus does something Sarah does not. He refuses to carry anything that costs more than his mortgage. No rotating credit card balance, no financed furniture, no buy now, pay later stacking up in the background. When he has surplus money each month, it goes to work. Say Marcus invests $600 a month. The same money Sarah is feeding to her credit card and interest payments. At a 9% average annual return, conservative but reasonable over long periods, $600 grows to around $112,000 in 10 years, $430,000 in 20, just over $1.1 million in 30. Now, let's be honest about that number, the way this channel always is. After inflation, in today's dollars, that figure is closer to $600,000. Still, from $600, from nothing more than refusing to stand on the wrong side of a line. What separates Sarah and Marcus? Not income, not discipline, not intelligence. Sarah is disciplined. She never misses a payment. The only difference is which side of one number they are standing on. Sarah's money is committed at 22%, working against her. Marcus's money is committed at 9%, working for him. Same paycheck, same instrument, one number pointing in opposite directions. Over 30 years, that gap, just from starting on the right side of the line sooner, is worth over $200,000. Not from earning more, from pointing the same lever the right way. If this is making you look at your own debts differently, hit subscribe. Next week, we're going to cover exactly how to build an investment strategy once your high-rate debt is cleared, step by step. Part 5. What schools actually skipped and why? Here is a question worth sitting with. Why did school never teach you this? Not the formula, not the line, not how to calculate what your debt is actually costing you per year. The easy answer is that schools are not designed to teach financial literacy, and that's true. But the more honest answer is structural. The financial system generates enormous profit from people who do not understand it. Credit card companies earned over $130 billion in interest and fees from American consumers last year. A significant portion of that came from people carrying balances month to month. People who, if they had understood the math, would have cleared those balances years earlier. Banks do not lobby for financial literacy education. Credit card companies do not send you tutorials on how to avoid paying them interest. Buy now, pay later services do not explain compounding to their customers. The system is not designed against you, but it is designed for itself. And the gap in your education, the one your school left open, is where it operates most profitably. This is not a conspiracy, it's just incentive. And the response to that incentive is simple. Learn what they never taught you. Run the numbers. Know which side of the line every debt in your life is sitting on. Because once you know, the advantage disappears for them and appears for you. In the next section, how the wealthiest people in the world use debt on purpose, not to spend, to compound, and how the same principle applies to you at any income level.
Part 6. How wealthy people use debt intentionally. You have probably heard that rich people borrow money instead of spending their own, that they use debt to build wealth rather than avoid it. Most people hear this and assume it is some exclusive trick, something that only works at a certain level of wealth, something inaccessible to them. It is not. The mechanics are the same ones we have been talking about this entire video, just at a larger scale. Here's how it works. Wealthy investors accumulate assets, stocks, real estate, businesses that appreciate over time. Instead of selling those assets when they need cash, which would trigger a taxable event, they borrow against them at relatively low rates. Say an investor holds $2 million in a diversified portfolio growing at 9% annually. They need $100,000 for something. The obvious move, sell $100,000 worth of investments. But selling means paying capital gains tax. Say that's $15,000 gone immediately. And the sold assets stop compounding. The alternative, borrow $100,000 against the portfolio at 6%. The portfolio keeps growing at 9%. The spread, 3% on $2 million, is $60,000 per year working in their favor. The tax bill is deferred, potentially indefinitely. That strategy has a name: buy, borrow, die. And it's real enough that legislators have tried to close it, and prominent enough to be widely discussed among serious investors. But here's the part most people miss. You do not need millions to use the same principle. The principle is borrow at a rate below what your assets earn and let the spread compound. If your mortgage is at 4%, and you're investing in a diversified index fund that historically returns 9 to 10% annually, you're already doing a version of this. Every dollar you put into investments instead of prepaying that mortgage is a dollar borrowing cheap and earning more. The wealthy are not playing a different game. They are playing the same game with more zeros, more risk, and more sophistication. But the rule is identical. Know your rate, know your alternative, keep the cheap debt, kill the expensive debt, invest the difference. Part 7. How to actually run this on your own debts. So what do you actually do with this? Here's a simple, practical process. No app required, no spreadsheet required, just a piece of paper and 15 minutes. Step 1. List every debt you carry. Credit cards, car loan, student loans, mortgage, buy now, pay later, all of it. Step 2. Write the interest rate next to each one, not the monthly payment, the annual interest rate. If you do not know it, look it up on your statement or log into your account. Step 3. Rank them from highest rate to lowest. Step 4. Compare each one against the line. For most people right now, that line sits somewhere between 6 and 8%. Above 8%, the debt is almost certainly costing you more than you could reliably earn investing. Below 6%, the debt is likely cheap enough that investing the difference makes more sense. Between 6 and 8%, it depends on your risk tolerance, your tax situation, and whether the rate is fixed. Step 5. Attack from the top. Put every extra dollar toward the highest rate debt first. When that is gone, move to the next one. Keep going until you drop below the line. Then, stop attacking debt. Start investing aggressively. One exception, and it's important. If your employer offers a retirement match, contribute enough to capture that match before anything else. A 50% match is a 50% instant return. Nothing beats it, not even a 22% credit card. Capture the match, then attack the debt, then invest. That's the order. And here's something the old advice never told you. Once your high-rate debt is cleared, your cash flow opens up dramatically. The money you were sending to interest payments becomes investment capital. Sarah, once she clears that card, has an extra $500 to $600 a month freed up. At a 9% return, that money invested over 25 years becomes nearly $600,000. The debt was not just costing her interest, it was costing her the compounding she could not start because the money was already spoken for. That's the real cost of high-rate debt. Not just the interest, the compounding you delay while you carry it.
Part 8. The asset side, the mirror image. Everything we have talked about applies to debt, but the same logic runs on the other side, your savings and cash. Most people keep their emergency fund or short-term savings in a traditional bank savings account. The national average interest rate on those accounts is around 0.4%. On $20,000, that is $80 per year. The same $20,000 in a high-yield savings account, widely available, FDIC insured, no extra risk, earns around 4 to 5% right now. That is $800 to $1,000 per year. Same money, same safety, 10 times the return. The only difference is whether you checked the rate. The debt rule and the savings rule are mirror images of each other. In both cases, the rate is the variable. In both cases, the move is to find the best rate and put your money there. In both cases, most people never look. Do not leave that on the table. Let's bring this back to where we started. You were taught to fear debt, or you were taught nothing about it at all. Neither prepared you for the real question, which is not whether to have debt. It is which debt, at which rate, compared to what alternative.
The people building wealth with debt are not smarter than you. They were not handed a different tool. They just learned which way to point it and they checked the number. That number is available to you. It is printed on every statement you receive. You have always had access to it. You just needed someone to tell you what to do with it. Now you know. Pull out your debts. Write down the rates. Rank them. Find the line. Attack from the top. Invest the rest. That's how debt stops being something that happens to you and becomes something you use. If this video gave you a new way to look at debt, share it with someone who needs to hear it. And subscribe to Gigi Invests, because next week we're breaking down exactly how to start investing once the high-rate debt is cleared. We'll see you there.